Look at these green and red candlesticks. Most ask, is the price going up or down? Beginners treat the market like a crystal ball, believing the perfect indicator can predict what happens next. But the market doesn't work that way. Prices don't move from a neat math equation. They move because of millions of competing decisions driven by human emotions: fear, greed, panic, and hope. Taking an environment built on chaotic human behavior and treating it as a predictable system creates the conditions for a total loss. Entering a trade with a certain prediction makes every market move feel personal. When the price goes against you, it doesn't feel like a data point. It feels like your confidence is being dismantled in real time. This leads to a destructive cycle. A trader, overwhelmed by their screens, will abandon their strategy, break rules, and take random positions to force the market to give their money back. Contrast that with a professional. When they hit a stop loss, they remain calm. They are indifferent to the individual loss because they aren't looking for a win, they're looking for a sample. Professionals don't suffer this anxiety because they aren't trying to guess the future. They have moved past the need for prediction and operate in an entirely different mindset. Professionals rely on the edge. This is the shift from looking for certainties to looking for mathematical probabilities that repeat over time. Think about the business of a casino. They generate consistent, massive profits year after year, yet they have no idea who will win or lose any specific hand. On a roulette wheel, the house has no way of knowing if the ball will land on red or black on the next spin. Every single event is random. But because of the green zero, the house has a slight, built-in advantage. Over thousands of spins, the math is tilted in their favor, giving them a small percentage lead over the players. The casino doesn't need to win every spin to guarantee wealth. They simply need to let the probabilities play out over a long enough timeline. This diagram shows a 60% win rate strategy. Out of 10 trades, expect 6 wins and 4 losses. Amateurs panic during those 4 inevitable losses, thinking the system broke, failing to realize they're guaranteed events within a winning strategy. This chart compares a $1 risk against a $3 reward. This ratio changes the math of success. With a 1-to-3 ratio, you can actually be wrong more than half the time and still grow an account. Just 2 wins can completely offset 6 consecutive losses. Every trade is an independent event. Like a coin flip, your last 3 trades have absolutely no impact on the probability of your next one. Viewing each trade as a unique, independent probability neutralizes the emotional sting of a loss. It's just one data point in a much larger series. If the math is this simple, why is the failure rate in trading so high? This chart shows an edge materializing. Over 10 trades, results are pure chaos. The steady trend only appears after 100 iterations. But traders destroy this math by being inconsistent, cutting profits early or letting losses run. Change rules mid-sequence and the edge disappears. Discipline isn't a motivational phrase. It's the strict mathematical requirement that allows the edge to appear in your account balance. The professional's primary job isn't making money, it's protecting their capital. If you run out of money, your edge is useless. Losing streaks or drawdowns are a mathematical certainty. Risking only a tiny fraction of your account on every trade is how you survive the math long enough to win. You also have to change how you define a good trade. Most people think a good trade is one that makes money. In reality, a good trade is one where you perfectly followed your rules and managed risk. The financial outcome of that single trade is irrelevant. Stop trying to predict the future. Disconnect your ego from the next candle and become a disciplined executor of the math.